Welcome to RCLCO's October Economic Update. I'm Scott Bommarito, and for the next few minutes, I'll be sharing some of the latest economic developments that we're tracking. One of the most headline-grabbing developments of the past few weeks has been the rapid increase in the 10-year U.S. Treasury yield, which has recently climbed to a 16-year high. The yield's been hovering around 4.5 to 4.75% over the last month, but on Tuesday, it closed out the day above 4.8%, and on Wednesday, it's broken 4.9%, so hovering just below that 5% watermark. Now, across the yield curve, long-term rates have increased over the past month fairly meaningfully, while short-term yields, in contrast, have stayed largely steady. However, the yield curve does remain inverted, as the chart on the right here shows. Now, a big question that many investors, a lot of our clients included, have been asking is, why has the 10-year yield risen so dramatically now? Many economists and market commentators have proposed various mechanisms, but ultimately no single explanation is satisfactory. One contributing factor among many is likely the growing optimism of a soft landing scenario. Investor consensus has shifted lately and no longer expects a recession in 2023, followed shortly thereafter by rate cuts. As an example of this, the latest Wall Street Journal and Bankrate economic surveys both showed a less than 50% recession probability in the next 12 months. And while the probabilities do remain elevated relative to historical averages, they have certainly moderated meaningfully from earlier in this year, when recession probabilities was the consensus expectation. So this, taken together with the Fed's higher for longer signaling, has likely driven investors to expect higher interest rates to persist in the medium term. A related factor to this is the stronger economic data that continues to post, both on the retail sales and consumer spending sides of things, and notably in the employment markets, which we will look a little bit more at shortly. This continued strong economic data has continued to put upward pressure on interest rates as well, and softened fears of a recession scenario. Another contributing factor to the recent run-up in Treasury yields is likely fiscal policy fears, particularly around rising government budget deficits and the correspondingly increases in debt issuances by the U.S. Treasury. This, of course, has been exacerbated by the fact that Congress has been stalled for the last 2 weeks, as the House of Representatives still does not have a Speaker of the House, and they're therefore unable to pass much-needed budget resolutions, and also unable to address the pending government shutdown when the government is projected to run out of money within the next month or so. A final possible explanation that's received some press lately has been the possibility that the term premium has been increasing. Now, this is a difficult explanation because the term premium cannot be observed, but there are several econometric models that suggest it's been increasing lately. Now, a few other market metrics that can be observed to get a sense of what's driving the yield curves are as shown on this chart here. The first is the TIPS implied inflation break-even rate. Now, the 10-year break-even rate has been fairly constant over the last year, hovering right around 2.3%. This is a little bit above the Fed's 2% target, of course. However, we've not seen any meaningful increase in the TIPS implied break-even rate over the last couple of weeks that would correspond to the run-up in the 10-year yield. So the suggestion from that seems to be that the increase in the 10-year yield is not primarily being driven by inflation expectations. The TIPS market just isn't showing that. Another metric to look at is the 10-year real rate, which since the end of the GFC has hovered pretty consistently in a range of plus to minus 1%. Now, in September, this last month, that real rate broke 2% and has hovered around 2.3% in mid-October. So taken together, the current run-up in interest rates does not seem to be primarily due to elevated inflation expectations, but rather it reflects an increase in real rates, which may suggest a rise in the term premium. Returning to the labor market, we continue to see robust growth. Job growth surprised on the upside in September, and July and August job growth numbers were both revised upward by meaningful margins. The expectation continues to be that job growth will cool and the overall labor market will slow down. However, as the chart on the right indicates, that slowdown has been slower than expected and not nearly as consistent as we expected at the beginning of the year. Digging into some specific markets, we can see some familiar trends. The Sunbelt markets continue to register strong employment growth with low unemployment, as shown in the top left quadrant of this chart. Gateway markets, in contrast, have seen employment growth much closer to the US average, with fairly variable unemployment rates. The Southern California markets, along with New York and Chicago, have seen elevated unemployment rates relative to the US average, while Boston and Washington, D.C. have been among the lowest unemployment rate markets of these top 30 employment markets in the US. We will continue to monitor the labor market as it remains an important part of our current economic climate. Well, that concludes our October update. Make sure to tune in to future webinars and follow RCLCO on social media to stay in the loop.